Good morning, my name is Gary Hans, I'm the Director at AMG Wealth Management. We're joined here today by Darren Johnson, who's the Senior Investment Consultant at St James's Place. Good morning, Darren.
Morning, Gary.
Thank you for joining us.
Pleasure.
Darren, I wanted to just have a chat with you today regards a couple of subjects I'm quite keen to understand. I think our viewers are keen to understand. There's been a lot of talk about active and passive investing. Can you explain to us the difference between passive and active investing, please?
Sure. As you rightly say, there's a lot of noise about active and passive, and it never really explains what it is and the different nuances. The easiest way that I can think of to describe it is the mainstream way of passive investing is that you invest your money across the range of everything, and the bigger the asset, the more you hold in it. So, for example, the largest company in the world, Apple, you will have more in Apple than you will, for example, Tesco. And the bigger that Apple gets, or the bigger that these tech companies get, the more you would get in these assets. Now, over time, if markets go up, they do well. If markets go down, they don't. And it can be as binary as that. With active investing, what you're looking for is to take advantage of the fluctuations in price along the way. So, for example, you won't hold everything, but instead you will hold the companies that you think are the cheapest and therefore have more potential growth. And along the way, as things fluctuate, you will dip in or out of different shares, taking advantage of opportunities or avoiding threats along the way. With passive investing, you hold everything. With active investing, you hold what you think are the opportunities of the day.
So is it fair to say, we've always sort of had the view, especially long-term investors, the view of you buying things at a good value and you sell things when they're not good value. Are you saying then that passive investing almost goes against that philosophy?
I think putting it simplistically, most people want their fund managers to be buying low and selling high. Mm-hmm. And passive investing doesn't do that. It's as things go up, you buy more, and you buy more, and you buy more. Long-term investment strategies tend to rely on selling at the right time, but buying at the right time as well. So buy low, sell high. So I think maintaining that strategy over the long term, active management has over time played more of a part in that than passives. However, in the short term, let's say over a few years, if the same thing happens over and over again, then passive can obviously add some value to portfolios. But over the long term, active and being able to move and be more flexible in your investment approach has worked over the longer term, which, depending on your timescale, we can tailor that to whatever the client wants.
Thank you, Darren.